Hi, welcome to Vijay's Views. Let's review HDFC Q3 numbers. The consolidated number grew by 20%, where the net profit alone stood at 10,800 crore for this quarter. It was a stellar numbers and they were in line with street estimates. On a standalone basis, the revenues grew at 13%. The net interest margin grew at 13%. The net interest margin is the difference between interest earned and interest given on deposits. And then NIM stands at 4.1%. Do note the balance sheet size of 2 lakh crore gaining 4.1% is really huge. On coming to the revenue segment, the other income also contributed to the growth of the bank's revenue, where the other income is now 30% of the total revenue. The other income included their derivative and their treasury income operations, the fees and commissions which they get by doing a cross-selling of project which stands at 5,000 crore as profit. Then they have their revaluation of their investments, and then the FX where they earn around 1,000 crore. When compared to the other banks, the reason for the growth of this bank is mainly the digital offering which they have penetrated in this last 2-3 quarters. And it's due to that they are able to lend advances at a 16.5% higher than the previous quarter, which is a substantial growth in this current context. Their management recently has signed MOU with 2 large payment banks for distributing certain products. This is a key information to note in the coming quarters, as the fee income will substantially increase in the days to come, which is a component of other income. So they are ensuring that the revenues keep clocking so that they can maintain this 18 to 20% growth in the quarters to come. Their retail asset banking has shown growth of 5% Q-on-Q and 13% on year-on-year basis. The Q-on-Q growth was particularly in the personal home loan segment and loan against property segment. The commercial and rural banking segment also grown at 6% and 30% year-on-year. It does shows how the HDFC is moved from the cities to the rural areas and capturing the market share gain. The operating expense was around 15% due to the addition of 294 branches in this particular quarter. And it is at par with the industry standards. The cost income ratio is likely to increase going ahead as they keep spending on the technology, and as well as the retail assets pick up, the cost to income ratio keeps going, but there's nothing to be worried or alarmed. And do note the liquidity coverage is 123%, which is a top notch which every top banks do maintain. The important key aspect to note is the check bounce rate. It has reverted back to the pre-COVID level. In fact, it is better than that. That's what the management commentary has said in the last con call. And the reason for that is, during the last 1 year, the bounce rate was very substantial, where the NPA shot up across the banking ecosystem. Right now, this is a good news. It shows that the stress at the retail level has come down, and it's a key indicator for the coming quarters as well as for the other banks that the NPA numbers should come down when compared to the previous quarter. The restructuring and the RBI resolution framework for COVID, they did have an impact of 10 to 20 basis points on their gross net profit, that is the growth non-performing assets ratio. Other than that, the management on the credit card basis, where they were banned by the RBI to issue new, the RBI did give them a new, I shouldn't say did give them, they partially allowed them to issue new cards, and they did issue 9.5 lakh cards. The spend increased 24% year on year, while the debit card spend grew 14% year on year. Now coming to their subsidiaries, which was tracked very closely by the market. They have 2, one is the HDFC Securities Limited and HDB Financial Services Limited. The securities in the HDFC Securities Limited, the bank holds 96% stake. And for this quarter, their total income grew 58% to 500 crore. And they do make a profit of 258 crore. While the important thing which the other investor communities note is the other subsidiary, which is HDB Financial Services. It is a non-deposit taking NBFC, and they offer a wide range of loans with a total loan book of 61,000 crore. And do note here the NPA was skyrocketed in the last 4-5 quarters, and investors panicked that this segment is not going to yield them good returns. But they did make a recovery, a very strong recovery, and this time they ended with a net revenue of 1,200 crore as against 1,700 crore when compared to previous year, with a growth of 15%, and the profit was around 300 crore when compared to loss of 145 crore the same time last year, which does shows that they have recovered a good chunk of NPA, which has ensured that the provisions be reduced, which is boosting up the profit. And the third stage 3 loans as per the RBI guidelines is around 6.5% of the total loan given, and the tier 1 capital adequacy ratio is at 15%, which is at par with the banking norms. So overall, the numbers are in line with the street estimates. Do note, the stock has given up a good chunk of returns in this particular last 6 months, despite growing around 18% last time due to the subsidy performances and the NPA concern which they had. The stock has given around 6 to 8% returns in the last 10 days. The market positioning of the stock is at par with the other result candidates. Expect a good traction of money flowing into this stock in coming days. The valuations are a bit stretched when compared to other banks. Yes, they are quoting at around 3.7 times the book value when we compare it with the other banks. But it's a good investment pick, and assume they clock the same 18% growth for the next decade. This is on the verge of becoming a $1 trillion market cap company. It's a huge achievement. Do consider for your investment in your portfolio. Do note that I am not a SEBI registered investor to suggest these stocks. Safe investing, folks. Thank you.